Billy and I are here at Twin Rocks Winery in Granite Bay, and we are so excited to talk about FHA loans and renovations.
That's right. That's right. Yeah. So FHA, you got about half the country that uses it when they buy their first home. I know you and I were chatting. What are some things that you had questions about, Lori?
Yeah, so you guys, I had to actually do a printout because this is not my lane. I don't do finance. I do not do loans. I'm a realtor. But I need a partner. I need a lot of partners. And a lender is a key partner for me. And I want to learn about FHA loans along with you. So I know there's some benefits. And one of them, there's 5 that I want to talk about. Let's keep it simple.
Yeah.
5 is that you can get a lower down payment. And that means that typically you can get as low as 3.5%, making homeownership accessible for first-time buyers, like you just mentioned.
Absolutely. So it's probably the biggest attraction to FHA is that you can go as low as 3.5% down on the purchase price. And here's the added benefit. It doesn't even have to be your own money, team. So you can receive a gift. That down payment can be partially or entirely from mom or dad, a cousin, a brother, sister. So that is a huge help. It just has to be 3.5%. But what's really exciting is that as an independent broker, I have some investors now where they're even making it easier. They're coming up with a second mortgage for that 3.5%. So you're getting true 100% financing. So really lowering that barrier to entering the housing market and becoming a homeowner.
I like it. So how would they get the gift from a family member? Do they have to have that in advance, or could they do it while they're in escrow, or when you as a lender are deciding whether they could be FHA to begin with?
So typically we don't want to see that gift coming in until you're already in contract, meaning you've signed a contract with the seller. And then to make it very easy, if it's mom or dad or a cousin, we just have them wire that money directly to title. And we do that so we can avoid the paper trail headache, which can be it's just a headache. It can be difficult having to show where money moved around.
Headaches are not fun.
Headaches are not fun. And then also parents or cousins, sometimes they don't want to show their accounts. And the nice thing is when we wire directly into the title company, we avail ourselves of that issue.
I like it. Okay. So number 2, a benefit of FHA is easier credit qualification. Apparently, they're more lenient. You can have a score as low as 580. Is that right?
Below that. So funny you should mention it. Last week I closed it's been 2 weeks, closed a transaction, and the mid FICO. So lenders, if you didn't know, it's important to know, lenders take a tri-merge 3 credit bureau report, so Experian, Equifax, and TransUnion. They throw out the low, they throw out the high, they use the middle score. Well, this family, they'd had some challenges with their credit. The mid score was in the 560s. And I have a couple of investors that will go all the way down to 550, which is incredibly forgiving. And gang, this is where FHA shines, because the other major bucket of loans, conventional loans, it's much more punitive if you have a low FICO. I'm sure you've dealt with this, where you have a buyer and let's say their FICO is even 680, which I kind of think of 680 as like C-level, kind of middle of the road. The rates are much higher than somebody that, say, has a 740. And the reason for that, and to understand as an FHA buyer, is the Federal Housing Administration, which is essentially the housing arm of HUD, Housing and Urban Development of the government. Part of their mandate is to create a catch-all, a huge net to help as many Americans be able to approach the home buying process as possible.
Okay, so you're saying that if you do have a lower FICO score, you can even get it with, I mean, that's only really if you have a higher down payment, right?
Nope.
No?
No, yeah. So so the family that just closed, and this is amazing, is that it doesn't hurt you that much on the interest rates. I mean, that it's going to be more expensive, but the family that I helped, they were still in the 6s with a credit score that was in the 560s, 3.5% down. So down payment's exactly the same. Yeah.
That's a good to know tip, huh?
Yeah.
Okay.
What's next?
Next, number 3, higher debt to income ratios are allowed. And I've definitely experienced that a lot with conventional loans. And I've lost a couple deals because of people not realizing. A lot of people love to look at houses. It's fun. And they love to hang out with people like me because I'm super fun.
Always.
And then
always,
they forget, they're like, oh, yeah, I got to talk to a lender. And I'm like, oh, you have not done that first. You are not pre-approved. You're not pre-qualified, which is a whole nother topic,
right,
which I've done a video on. But it's like, come on, let's talk about that.
Yeah, so debt to income, just to kind of take a step back and break down what that is. In layman's terms, we've got all this jargon we use as lenders. It simply means for every buck, for every dollar of income you have coming in as gross before taxes, how much is going to go out as a percentage for that proposed housing payment, which includes the mortgage payment, the principal and interest, property tax, home insurance, fire insurance. If it's a property in a homeowners association, that gets included. And then if you buy a property in, say, like some areas of Sacramento where there might be flood, that gets included. So all that, plus any other debt you already have. So it might be a car payment. If you have existing student loans, you're carrying balances on credit cards. If you pay the credit cards off every month, it's not counted. But that gets expressed as a percentage. So if for every dollar, 45% goes out for the proposed house plus my expenses, I have a 45% debt to income. The problem for a lot of first-time home buyers, that is often the biggest hurdle we face that frankly keeps them from buying a house. And so FHA is incredibly forgiving, and they've risen that limit in recent years to 55%, in certain cases even 57%. And why I say certain cases, that loan gets put through a risk algorithm that looks at your work history, it looks at your FICO score, it looks at how much are you putting down? Do you have any reserves? Meaning, do you have any money after you're going to close? So it's going to look at that. So to be clear, not everybody's going to be able to get to 55, 57, but most of the time we're going to be able to get to 50 to 55%. And that just gets so many more people into their first home.
I like it. And you guys, we're in California. We're not talking Kansas.
We're not talking Kansas.
It's possible.
It is a stretch. I know when my wife and I bought our first place 20 years ago, it was a stretch.
Yeah. No kidding. So the next one is competitive interest rates. I have noticed when I get emails from various lenders, there's the veterans loans, there's the FHA loans, and there's conventional, and FHA tends to be in the middle.
Yeah.
VA loans are obviously easier to get for people, and as rightly so, right? But it helps people make payments more affordable, especially if they have those low credit scores that you were just talking about. So can you expand on that?
Sure. So let's take a conventional loan. Once again, that's the other bucket. And again, when we hear conventional, those are the loans that Fannie Mae and Freddie Mac, these government entities, buy those loans. They establish the guidelines. So you really have two major buckets, FHA, conventional. The challenge with conventional is if I have a 660 FICO, Lori, and then my buddy has a 740, his interest rate might be a half a point better. It's a lot. And with FHA, on average, an FHA loan, even if I've got, let's say, a 680 credit, I'm going to be a half a point to 3/4 of a point better than my friend that has the same FICO score on a conventional loan. So there is some downside, and we'll talk about that. I know you got some things about downside, but the interest rate is going to be lower. Yeah, with FHA.
Okay, I like that. I love working with first-time home buyers. They need a lot of patience, a lot of hand-holding. I am totally up for that. 22, I will say I had a little bit of a challenge with first-time home buyers because the market was so crazy. But today, that's a whole nother story. I'm ready to hold your hand and help you out. So the last one, assumable loan rates. So assumable loans, that's just like a whole nother world to me. But I really like the idea that you could have a future buyer take over the original loan, right?
Oh, yeah, this is a big one.
And if the property is sold. So that's a huge opportunity for someone that's coming along with high interest rates. And I do understand it in the conventional loan world, but not necessarily in FHA. I didn't even know you could do that.
Give me a second. I'm getting chilly out here. I'm going to throw the old beanie on here. So this is such a big thing. Now, the important thing for people to understand is you're not going to come across this a lot, but boy, when you do, what an opportunity. So with both FHA loans, the Federal Housing Administration, as well as VA, Veterans Affairs loans, these are loans that can be assumed. So what that means is that if you have a buyer, and let's say they bought in 2021, when we had all this artificial government stimulus that drove interest rates down to historic loans, people getting rates at 2.5, 2.75, 3%, right? Why America's not moving, right? Right. And so if that person decided they were going to sell the house, if I'm a veteran or if I'm an FHA buyer, if I qualify, I can assume their loan, and it's huge for the seller because they are able to promote, hey, I know the market's at 6.5, 7%, but if you qualify, you can assume my loan, which is such a game changer. Funny little anecdote about that. I was referred to a client just through my network in Auburn, where we live, and we were just out on a Sunday enjoying some lunch and beverages, and they said, look, we feel really bad, but the husband's a veteran, served our country, and they said we have an opportunity, and this house, the loan's at 2.625%, and we feel horrible because we've been working with you for a while. And I just interrupted and I said, don't feel bad, you'd be an idiot if you didn't take this loan in this house. And they did, and I was thrilled for them because those opportunities are far and few. So most agents will promote it, as you know, right? They'll let you know, but not always. So if you are looking at a property, it's always a good idea to ask, what kind of loan does the seller have a loan? What kind of loan do they have? Because and this is the key takeaway on this bullet point, Lori, 99% of people that sell homes that have an FHA loan, they don't know their loan's assumable. They don't even know that that's a feature. So it's a good thing to have your agent as the buyer bring up with the listing agent for the seller.
Yeah, and now that I know this, I have some young clients that just had their second baby. They bought a tiny house, and they know they have to move because there's no room for the second child.
Oh yeah.
They do have an ADU on the property, but what are they going to do? Stick the baby in the ADU? No. They. I'm going to point that out to them, and I do see it in private remarks in the MLS occasionally, but I don't feel like it's very frequent, and it needs to be.
Yeah, I agree.
Okay, so I'm super real with you guys. I don't want to be like, oh, like Miss Positive, everything is amazing.
Blue sky.
Yeah, the sky is gray today. Poor Billy had to put his hat on. Our butts are cold. We're sitting on, what is this, ceramic tile?
Something like that, yeah.
There's cushions right next to us. Why aren't we over there?
Wrong spot.
Anyway, we wanted to share the lovely fountain with this big pond with you. And we are 20 minutes away from here in Auburn, by the way.
Very close by.
So what I'm getting at is some challenges of FHA loans. Mortgage insurance premiums. They require both an upfront mortgage premium that's typically 1.75% of the loan amount and an annual MIP payment. I have no idea what I'm talking about, so I need you to clarify.
All right, so let's talk about this. So think of the price of entry, if you will, the entry into Disneyland to use an FHA loan is a 1.75% fee that goes to FHA. It's known as the UFMIP, which stands for the Upfront Mortgage Insurance Premium. Okay. And that basically insures the program. So, sadly, there will be people that lose a job. For whatever reason, they foreclose on a house. They have to give the house back to the bank. And so that keeps replenishing the coffers and keeping that money coming in. Now, here's the good news. I'm going to say 99%. I've never had one. I've done over 500 FHA loans. You don't have to pay it out of pocket. It gets built into the loan. So they're going to take that. Let's say you're putting 3.5% down, just that FHA required minimum. They're going to take that 1.75 and they're going to just build it into the loan. So your loan's going to be a little more. So if I had a $500,000 loan, that is going to be about $9,000 hair under that's going to be added. So that's FHA's, that's their cost.
They should do that for buyer's agents now.
Right? Yeah, they absolutely should. And in addition to that, they are going to charge a monthly mortgage insurance. Now, that's going to depend on how much you put down. But if you were putting 3.5% down, it works out to 0.55, a little over half of 1% of your mortgage each month. So if I had a mortgage of $400,000 or $500,000, that might be about $250 a month. So there are certain hurdles. The other thing with FHA, and you know this as an agent, is sometimes, and I'll almost say unfairly, sellers will perceive FHA buyers as weaker, and the FHA appraisal process is more stringent. It is a little stricter.
We
but,
haven't got there yet.
Yeah. Oh, okay. Oh, oops.
That's okay.
Okay. So I think those are the main. I think that's really the main thing. I mean,
there's a couple more.
Yeah. All right.
Well, you brought up appraisals and being challenging, but before we get there, property standards. If there's some safety issues, like let's say you have a deck and it's got dry rot, or I should say water damage, and it's fallen apart, there's no railings, or the railings are more than 4 inches apart, those are all safety hazards that an appraiser is going to pick up, and you may not be able to qualify for FHA loan.
Correct.
It's going to need, you have to get them resolved during escrow. You can't say, yeah, we'll take care of this after we close, which is possible with a conventional loan, but not FHA. Correct?
It is. So the Federal Housing Administration is a little more stringent with appraisal requirements. And so what Lori just mentioned, if you're the seller and the appraiser calls this out, because the thing to understand, team, is the bank that's going to give you that rather large check for you to buy the home, they're relying on the input, the commentary, the narrative of that appraiser. And so if they call out certain things, FHA will require, in order for you to move forward with that loan, to remedy that situation. Whereas conventional, once again, those are the Fannie Mae, Freddie Mac loans, those are going to be more lenient in that respect.
Right. So,
and here's a good thing, just so people understand, is I could be FHA, but let's say I had the house appraised and something came up and they're not willing to remedy it. If financially it's possible, I could always pivot to a conventional if I had to.
Yeah.
So just understand, you're not pigeonholed into the loan if there's a way you can make a conventional work.
I like that. So you have options.
You have options.
And back to that stricter appraisal process, it's really just that it just adds more time and complexity, and you may not be able to close in 30 days.
Right.
It could take a little bit longer, and that's why sellers could be discouraged, because they want that time frame, because they bought another house, they're moving out of the country, something's going on, and that's what makes them a little nervous, right?
Yeah, and that's not to say that an FHA loan, I don't want people to think if they're FHA buyers that they can't close fast. They can, but
only if there's an issue.
I'm gonna say that everything has to be aligned. They've got to have their money available, right? It can't be, okay, we have our 3.5%, but it's going to take a while, and we've got to liquidate some retirement accounts, and we don't know where the gift's going to come yet. And gee, the property, it could appraise with issues, it might not. That's where we have to take a step back and say, okay, we might want to negotiate with a seller a longer escrow period. Whereas if everything is a green light, we might say, okay, we can do this in 3 weeks. So,
okay.
All right.
There was one in here, but it was a little boring, so I'm just going to skip to the end. And that is, if you are an investor, that's just not going to work. It's intended for a primary residence. It's for not just first-time home buyers, but someone that is going to live in this house full-time.
Right.
Correct?
It is. And on that note, can I tell you one of the absolute best, most amazing things of FHA that people don't know?
Yes. Yeah. What? No.
So if I could go back 20 years, Lloyd, this is what I would do. Okay. Even married, even okay, maybe not with a kid, but FHA will allow you to buy up to a 4-unit property as long as you occupy one of the units. So owner occupy one unit, rent out the other 3, which could easily pay the whole mortgage, or a triplex, 3 units, or a duplex. I can do that. I can live there for 1 year, just 1 year. In 1 year, now I can rent out the unit that I lived in, and I can use FHA and do it all over again.
Damn.
That's amazing. People don't know that. So FHA provides so much flexibility that people just don't know about, because their lender doesn't look under the hood, or they haven't researched the program. So I'm a big fan.
Okay, so I have some clients I need you to call and chat with that might be at that.
I'm on board.
Okay. Well, we're going to talk about a renovation loan in another video.
Yep.
And if you want to talk more about FHA, definitely reach out to Billy. And if you need a realtor in this area, Auburn, Granite Bay, Folsom, Loomis, Newcastle, Penryn, I am so happy to help you. I love this area. And if you want that rural lifestyle and you love wineries, you like breweries, distilleries, that doesn't, I don't know if that sounds good. I honestly don't really drink that much, only when I'm with Billy. So
Oh, selling me out.
just kidding.
It's an amazing place to live. I mean, we talk about this. Once you're here, you don't look in the rearview mirror. You're just so happy you're here. So come check out the foothills. You won't be sorry.
Yeah, I did live in San Francisco, and I thought, oh my God, I can't handle this. So boring. There's nothing to do.
Yeah.
That is not true. You just have to, there's give and take, adjust to the lifestyle, and you certainly will not want to go back. Who wants traffic? No. Thanks for your time.
Thanks, Lori. A lot of fun.